In 2007, one decision erased over $40 billion in shareholder value. Not by a rookie, by one of the smartest CEOs in the room. He had the data. He had the analysts. He had the warnings. He ignored them anyway. Here is the uncomfortable truth. Most corporate collapses are not caused by stupidity. They are caused by success that goes unchecked. And the higher someone climbs, the more dangerous their confidence becomes. Over the next few minutes, you will see exactly how intelligent executives walk straight into preventable disasters. First, the psychological shift that happens after repeated wins. Second, the specific decision pattern that turns confidence into liability. Third, the moment when warning signals stop registering inside the executive brain. By the end, you will recognize these patterns in real time, in companies, leaders, and maybe even yourself. Write this down now. Intelligence does not protect against ego. Structure does. Let's open the file. The rise. When success starts bending reality. Success changes people. Quietly. A CEO builds momentum. Quarter after quarter of growth. Analysts praise every move. At first, discipline drives results. But then something subtle happens. The brain starts connecting confidence with correctness. Not with probability. Not with risk. With certainty. This is where the drift begins. Real example. A high-performing CEO leads a company from $2 billion to $9 billion market cap in 5 years. Media calls him visionary. The board gives more freedom. Inside the executive's mind, the feedback loop tightens. Past wins start feeling like proof of future accuracy. Rewind this if needed. Success builds pattern recognition. But it also builds blind spots. And it gets worse. The psychological crack. Here is where most outsiders misunderstand failure. Smart CEOs rarely think they are gambling. They think they are seeing what others can't. That belief is intoxicating. Consider this pattern. An executive makes 3 aggressive bets. 2 work. 1 barely survives. The brain does not store the near miss as danger. It stores the wins as validation. This is called outcome bias. One-line explanation. The brain judges decisions by results, not by the quality of the risk. Write this down now. Good outcomes can hide bad decisions. And the bill always arrives later. Example. A CEO approves a leveraged expansion during a hot market. Revenue spikes 18%. Stock jumps. Internally, risk models were flashing yellow. But success drowned the signal. Here's where most quit thinking. The strategic mistake. Now the executive crosses the invisible line. Not because of greed. Because of overextended pattern confidence. Watch closely. Step 1. The CEO increases position size. Step 2. They compress risk timelines. Step 3. They dismiss friction as temporary noise. Real-world style scenario. A company with stable cash flow takes on $5 billion in new debt to accelerate expansion. On paper, it looks rational. Market is strong. Analysts are optimistic. Internal models assume smooth growth. But one assumption is fragile. The future must cooperate. The future rarely cooperates. Within 18 months, conditions shift. Demand softens. Credit tightens. Margins compress. Suddenly, the same leverage that boosted growth begins to suffocate flexibility. And this is critical. Rewind this if needed. Leverage removes your margin for being wrong. And even brilliant executives are wrong more often than they admit. The collapse phase. Collapse is rarely explosive at first. It starts quiet. Missed guidance. Soft earnings call tone. Subtle executive turnover. Investors feel it before they can prove it. Then the numbers surface. In our opening example style scenario, $40 billion in value erased. A credit rating downgraded. Emergency restructuring begins. Not because the CEO was foolish. Because the system became fragile. Fragility hides during good times. Here is the brutal pattern. High performers optimize for growth. Elite survivors optimize for survivability under stress. Most leaders never test the second one. Pause and write this down now. Speed magnifies mistakes. Leverage locks them in. And the psychology behind this runs deep. Why warning signals get ignored? By the time red flags appear, something dangerous has already formed. Commitment, public positioning, board expectations, market narrative. Backing down now feels more painful than pushing forward. This is escalation of commitment. One-line explanation. Humans double down to avoid admitting earlier mistakes, even at the executive level. Especially at the executive level. Ego hates retreat. The CEO is not blind. He sees the pressure. But the machine around him is already moving. Analysts expect growth. Employees expect expansion. Investors expect confidence. So the decision window narrows. And then, the correction becomes unavoidable. Smart CEOs do not usually fail because they lack intelligence. They fail because success rewires their risk filters. Slowly. Confidence becomes insulation. Momentum becomes pressure. Leverage becomes a cage. Here is the lesson most executives learn too late. The market does not punish stupidity. It punishes fragility. Write that down. The leaders who survive longest do one thing differently. They build systems that assume they will eventually be wrong. Because they will. Because everyone is. If you want to understand the business world through psychology, not headlines, you need to see these patterns early. Subscribe to understand the business world through psychology. Study the pattern. Because in business, the most dangerous moment is not failure. It's unchecked success.